I'm Donna Walcavage. I'm the co-chair of the Design for Risk and Reconstruction Committee at the New York chapter of the AIA. And we're all happy to welcome you here tonight. The panel is going to speak and take questions from the audience, but afterwards we will still be here for networking. There'll still be some food and drinks out, so do stay, and you can ask questions individually of the speakers who are here. And I'd like to introduce our moderator tonight, is Klaus Jacob. He is a geophysicist who I met not long before, I heard speak not long before Sandy. Of course, no one listened to him, and then I got to speak with him again after Sandy. So his work has very much been involved in resilience in New York since before we woke up. Klaus.
Thank you, Donna. And this will be an interesting panel of highly dynamic nature. The reason for that being is because the first news is that we will have only 3 panelists, namely Serena Saros, had to bail out. She, as a single mother with 2 kids living in DC, was on the screen per video, but her babysitter got the flu and she couldn't find a replacement. So for a while we entertained even the idea that she may be on the video with her 2 kids in the background. But she thought that was a little bit too experimental, so I hope that everything will work out for her, but we will have to do without her. We also just learned a few minutes ago that Lori Sherman will not be with us until 6:30. So we have plenty of time for introductions and start our conversations with the 2 panelists that are here, namely Tally Burley, who, as it says here, is the manager for climate risk and insurance at the Environmental Defense Fund. Thank you for taking your seat here. And the other one is Paul Rosito, who is currently the president of the New York Metro chapter of the American Planning Association, certified planner. And Lori, I will probably introduce when she shows up, but as it says here, she is a Chief Investment and Impact Officer at the Partners for Common Good, which I think can be called an NGO. I would say so. Yeah. And she had other jobs before, namely in the White House. She was under the Biden administration responsible for housing and climate-related issues, and only recently joined the Partners for the Common Good. So the title is How Insurance Availability Affects Planning in High-Risk Areas. And since we are a largely New York metro region-based area, high risk means, for the most part, but by no means exclusively, particularly in the context of climate change, coastal storm surges, and amplified increasingly by sea level rise. We also have seen over the last couple of years heavy rainfall causing urban flash flooding, even causing fatalities, believe it or not. We have heat here. We even had a little bit of a drought last year with a few wildfires in Prospect Park and in the surrounding area on the other side of the Hudson. So wildfires, while we have heard a lot about them lately out from the West, are not entirely to be forgotten in this area either. So climate change is one of the major drivers of an increasing risk situation around the metro area. Now, risk is what? Risk is the potential for future losses. And since they are future, that means they are highly uncertain. Risk can be broken down into three elements. The first is the hazard, for instance, a flooding hazard, and you can find that mapped out by FEMA on a flood zone map for your neighborhood. And it has a probability, 1% chance per year, for instance, the base flood elevation that FEMA uses for most of it. So this is the hazard. So it has the probability per year as a unit of occurring. Whatever the hazard is that you define, whether it's probabilistically or for a particular scenario event. The flood height of Sandy. Okay. The second component of risk is the exposure or the assets that are exposed to the hazard. That's your homes, buildings, infrastructure. And they have a dollar sign on it. So now, when we multiply hazard by the asset, we have a probability, let's say per year, of a loss if you annualize the losses. Or for a given event, it's the loss of that particular event, namely whatever got damaged of your assets. But there's this third factor that contributes to risk, and that is the vulnerability of those assets given the hazard. And that has a dimension between 0 and 1. 1 means the whole thing is gone. 0 means nothing happens to the asset. So it's these three components that make up risk. Now, how do we manage risk now? We know how to measure risk. And you can't manage what you can't measure. But now we know how to measure risk, right? By taking those three components for each asset, and then for the neighborhood and the whole city and so on. One interesting way how risk can be managed is you can try to tame the hazard, particularly in coastal areas, by levees, dams, and barriers. That's called protection. But there are other ways to do it. Maybe the overlap between the assets and the hazard, whether you put your assets inside the flood zone or outside, makes a big difference. So zoning is one way to manage risk. It's politically not very popular, but it should be used, and probably in the future will have to be used more and more as sea level rise becomes more prominent. The third component, the vulnerability, is the interaction between the vulnerability and the assets. And that's where architects and building codes and engineering standards come in. Because you can have a building that's highly vulnerable for a given hazard, let's say for a given flood height, or you took that account in the design, and lo and behold, it will show a much lower vulnerability and therefore a lower loss for a given hazardous event. So these are the kinds of things, zoning, engineering codes, design of buildings, and so on, that can be used to manage risk. Now, I used up all that extra time, which I didn't plan to do, because we have a little extra time before Laurie Schumann comes on. But let's get to the panelists that are here. And I want to start with you, Tally, telling what you have to say as intro to this topic from your background and professional experience.
Of course. Can you guys, is this on, first of all? Okay, great. Well, thank you, Klaus, and thank you to AIA for hosting tonight. I'm really excited about the conversation and to hear from Paul and Lori. As Klaus mentioned at the beginning, I'm from the Environmental Defense Fund, and so if those of you are not familiar, we are an environmental global nonprofit. We work through data, science, and research to identify policies and advocacy solutions that help to stabilize the climate, help people and nature thrive, and help people in their public health outcomes that are impacted by the environment. You'll notice in that description that we have a huge emphasis on people, and that's because we're really interested in how environment and climate change are impacting people. And a huge piece of that is the economics and the financial impacts that people face as a result of a changing climate. And so we can't talk about that without talking about insurance. Insurance is one of those things that people kind of eyes glaze over the moment that they hear about it. I love talking about it to the chagrin of my friends and family, probably way too much, but I recognize that most people don't. And that's partly because it is inherently something that we use when a bad thing happens. That is why it is there. It is a financial protection when a catastrophe occurs. But it is also really, really important to our overall economic society, how our economics function, and the financial resilience of people and communities, especially in light of climate change. So I want to just take a minute to maybe unpack some of that, because I think in tonight's conversation, as we think about adaptation, as we think about climate change, we have to be thinking about insurance, but we also have to be thinking about how adaptation and insurance are working together. You cannot get a mortgage without having insurance. You can't buy a car without having insurance. And so if the insurance markets break, the financial and economic growth that is possible in an area breaks as well. All financial systems sort of end up toppling. So that is a really important thing that we are seeing, and the trends that we are starting to see is that as the risk is increasing, as we are starting to see more wildfires, more floods, more hurricanes, windstorms, hailstorms across the country, including in places that are sometimes least expected, freezes in the southeast, heat waves in the Pacific Northwest, insurance is having to adjust to undertake that risk and understand it, and that's causing some breaking points within the overall system. Insurance is also really important for financial resilience. So we've done a lot of research that has shown that people who have insurance are able to rebuild and recover much more quickly than people who do not. And so again, as we're thinking about climate change and increasing disasters that are happening at a greater frequency and intensity, having insurance becomes an even more important resource. What happens when people don't have insurance is that they have to rely on federal disaster assistance, which is not guaranteed and often takes a really long time. It doesn't always cover everything. or they have to dip into their personal finances, which can be tough for anyone. The average American doesn't have $400 in savings. When we think about the size and cost of disasters, we're talking several $1,000s of damages. $400 is not going to cover those expenses. People also might start having financial coping mechanisms if they don't have insurance. That means that they're delaying really important payments, or they're trying to take out extra additional lines of credit, which adds to their debt, that impacts their credit score. That's all really challenging for anyone. It's particularly challenging for low and moderate income households and communities, marginalized populations who often have limited savings, have difficulty accessing credit because of historic discriminatory lending practices. And those are often the people who are in the areas that have the highest risk and are the most vulnerable and susceptible to climate change. And so when we think about insurance, that is a really important tool to help with our overall resilience as a society in the wake of climate change. We can't talk about insurance without talking about adaptation and climate mitigation, because the problems that we're seeing in the insurance market, and I think we're going to dig into this a lot more over the course of tonight, have to be solved by thinking about how do we address the climate crisis. Because we have a tinge more time, I just want to take a moment to say just a couple of things, because we're talking about insurance really broadly in tonight's conversation, but there is private insurance, and that's the traditional homeowners insurance that many of us are familiar with, renter's insurance, car insurance. But we're in New York City. I'm a New Yorker. I used to work for city government, and as Klaus mentioned, flood risk is a major concern in this city, and flood insurance is actually separate from private insurance, and there's a whole other sphere of the National Flood Insurance Program and how that is managed through the federal government that has some different levers to the conversation that I think we'll touch on tonight, but I just want to sort of put that out there as insurance is a really big kind of complicated universe that we're dealing with. The challenges are still the same because we're seeing climate change happen everywhere, but some of the policy levers and opportunities within the planning and land use space are a little bit different.
Thank you, Tally. So I'm going to take a more geographic approach to talk about the implications on our professions and the implications on our communities. So I think what's important to set the stage as we're talking about insurance and how our professions have a role is talking about how we got here in the first place, right? And so just giving a little bit of table setting, not quite the full history of the Byzantine Empire, but where does modern zoning come from? Comes from the teens and the 20s. Where does the modern building code come from? Comes from roughly the same period of time. Obviously, there are building code requirements there prior to. But what that does is that starts to set the stage for where we say to people that you have the assurance of living here, not the insurance, but the assurance of living here safely, right? And so, importantly, you don't see really a wide expansion of our housing stock in the region, right? Not necessarily in New York City, but in the New York region until the suburbanization that stems from the Second World War and beyond, right? Now, why am I telling you all of this, right? I'm telling you this in part because we start to assure people that they can live in areas that now we determine to be vulnerable, and we start to build a significant amount of that housing stock before we really appreciate what climate risk looks like. And as we know from our professions, because we're talking about, part of the market overall is the physical asset that's to be insured, right? We have built a tremendous number of structures throughout our region in areas that are now at high risk. And in addition to that, as we know through our professions, we have structures that didn't even meet the appropriate, for lack of better term standards in the 1980s and 1990s because they were legal non-conforming. We have a number of structures, even before the modern flood insurance program requirements stemming from the 80s and otherwise, that were bungalows that were winterized after World War II, right? And so that brings us to today. Our professions really didn't start to appreciate flood risk until after Superstorm Sandy, right? And so where we found, in arguably Irene and Lee, if we're talking about upstate, again, I'm talking about our region as a whole. And the challenge that we find is that our professions after Sandy are confronted with the fact that we've built a tremendous amount of housing stock in areas of significant flood risk that we have effectively been ignoring by virtue of policy over the course of a period of time. Concurrently, we are now dealing with intact communities in place in a way that we didn't when we created the zoning in the first place, right? So, as you know, often when you're doing a site plan or after when you're doing zoning in a community in the first instance, that creates the community in and of itself. So you're talking about, you know, a group of perhaps 10 or 15 people talking about where 1,000 will live. Well, once you have 1,000 people living there and you have zoning and you have a comprehensive plan for that community, it's much more difficult to change how you're going to approach settlement within that community, and that's been particularly difficult as it relates to resiliency and climate adaptation. And so that brings us to, after Superstorm Sandy, our professions are now grappling with this result, right? We have housing in areas where it is no longer determined to be safe into the future based on climate projections that we know. We have zoning in place where we had here prior to given people assurances that they could live there safely. We are now looking at how we can change how people might live to reduce the risk, but now having to confront large intact communities that need to be consulted in order to value engineer how settlement might change over the course of time and impact real people's lives. And also in the context of this, we have, you know, concurrent issues that continue to come up, right? Our professions over the course of the last 10 years have had to see the implications of Superstorm Sandy, where we focused. Then Ida was a significant focus. Ophelia was a focus. And each of these events presented a different kind of challenge as it relates to tidal and coastal flooding, large-scale cloudburst events, and sewer inundation. And we see examples all throughout our region where we're trying to grapple in real time with how to figure out how to reassess what human settlement looks like in those areas to live safely, to assure people that they can live there. And ultimately, what we are finding over the course of time is that providing that public safety to communities also is seeing this concurrent symptom, which is insurance. And the way I like to think about insurance and the fact that insurance rates have gone up is that it's a financial acknowledgement that is riskier to both live here and both to securitize an asset here, which, of course, as Tally rightfully said, relates to your financial future.
Okay, thanks for those two introductions. I think I want to start with a question because we still have a few minutes before Lori supposedly will come online. And Tally, I probably want to start with you and ask you, do you think, given the risk increase and the related increase in the insurance premiums that are necessary to cover the existing risk, that insurance will be in the future truly affordable, particularly for low and middle income people, including renters? Yeah? They also can buy flood insurance. And what does this mean? I mean, it will be difficult for homeowners to pay back your mortgage and pay an increased insurance. I think I heard in the New York area, it doubled over the last 4 years, the insurance premiums. That is an incredible burden on homeowners that have a mortgage.
Yes. So there's a lot to unpack in your question. I think, so starting with the concept of insurance rates going up, and it's unfortunate that Serena can't be here because she is the insurance person and will be able to talk about this way better than I can as the policy advocacy individual. But I just want to maybe take a couple of steps back, not to dismiss the question, but to just talk about insurance a little bit more, because insurers are looking at the hazards that we're facing. They're looking at the risks. They're looking at there is flooding, there are wildfires, there are windstorms, but they're also looking at a variety of different things that a property and asset faces. I live in an old building in Brooklyn that has outdated electrical. We had difficulty renewing our insurance last year because of our faulty electrical systems. That doesn't have to do with the climate. And so there are these other factors that are also contributing to increasing insurance rates. Climate is just so extreme that that is having that role. The difficulty in terms of insurance affordability is that there is always going to be a segment of the population that is going to struggle to pay for insurance. There are people who live paycheck to paycheck. That is always going to be the case. And so what we need are financial models that can provide coverage for those gaps and make sure that people are not uninsured or underinsured. And that is a trickier question. And in order to get to a place where insurance can actually be affordable for the majority of people, we need to be doing adaptation. We need to be thinking about our land use strategies, our building code strategies, our zoning code strategies, types of infrastructure and resilience and protection that can lower that risk to better align the insurance prices to a place that actually can be, where communities can be resilient and insurable. Flood insurance is a whole other beast again, which is, because it is a federal program, the NFIP is managed by FEMA. And so FEMA has been doing some changes to the program to change the way that they price insurance. It used to be that in the NFIP, there was the flood map, and you were in a flood zone and you were out of a flood zone, and that completely drove what you paid. If you were out of a flood zone, you're paying maybe a couple $100s. If you were in a flood zone, there's a chance you were paying several $1,000s. And it wasn't taking into account kind of the gradation of risk that we know, multiple types of flooding. A lot of the pricing and really looked just at coastal or riverine. So what we saw in New York City during Hurricane Ida, that type of flood risk wasn't accounted for. Climate change isn't accounted for. And FEMA has taken this step to change the way that they price it to look at the properties in more of a gradation. So they're looking at how close is something to a flood source, how high is that first floor, what's the replacement cost value of the property if you replace it in whole. And so they've started to take those steps. That's showing that risk is a lot higher than we thought, and that was being shown in the pricing before. Policies are going up. 18% for a year is the cap for flood insurance. Homeowners insurance, because it's private, is a more complicated space. But because flood insurance is a federal program, a lot of those changes and the cushions to help low and moderate income households require congressional action. And there has not been major reform to the NFIP since 2015. We've had over 30 short-term extensions. Like, a lot of things, the can just keeps getting kicked down the road, and that does present questions around how do you create an affordability program so that the people who need the resource the most can still afford it. On the private market side, some states have put caps in terms of how high premiums can rise each year. Some states now have requirements that certain adaptation strategies are actually accounted for in the pricing. Those are all really important steps to make sure that adaptation, which is needed to lower insurance costs, is actually accounted for to help make these policies more affordable. I'll stop there, because I thought I saw Lori for a second, maybe behind me. But.
Paul, you want to add something at this point? Or?
Sure. So I agree with everything that Tally said, of course, and I think that our professions play a role in adaptation. So there are a number of different ways that plays out, right? So if you're approaching a site plan with a developer, then making sure to factor for reduction of risk in an otherwise flood-prone area based on whatever the risk may be. That's one tool that you have. Another tool that you have is that when someone's making a renovation or a substantial improvement to a building, making sure to articulate to that individual, that developer, that property owner, that elevation may, in the long run, hey Lori, may save them some resources. And then lastly, many of us work particularly planners, work in government, and it's looking at how to work with our communities to facilitate and advance community-wide adaptation, because not in New York City, but outside of New York City, many communities, Long Beach on Long Island, for example, participate in the community rating system, which is regulated by NFIP, and that's a key driver in being able to appreciate the fact that a community is taking proactive steps to adapt, and that facilitates an evaluation that helps lower the flood insurance in that particular jurisdiction. Now, as it relates to, but I can't emphasize more what Tally said, which is that insurance is an ecosystem where flood insurance, which is directly associated with climate change for flooding, as we've considered it, it's a larger, more complicated situation that I think we as planners and architects have to figure out how to grapple with on a disaster by disaster basis.
Okay, we have Lori now on the screen. Thank you for making it on the wall here. I introduced you briefly already, but just to remind people that Lori is with the Partners for Common Good, but had a role in the prior administration in the White House to worry about housing and insurance and the likes. So would you want to give your initial remarks about this topic altogether, and then we get you involved into the Q&A as well?
Klaus, absolutely, and it's an honor to be here. I hope everyone can hear me okay.
Yep.
Yes.
Great. And it's so wonderful to see Paul, because Paul did not tell you all this, but we worked together for, I think, almost a decade, building resilient housing in New York State. Some of the best and most cutting-edge stuff that I think you could find anywhere in the country, including, Paul, you'll have to forgive me for shouting it out, because it's such an important project, the Freeport Housing Authority Moxie Rigby site. We built a community climate resiliency center in Binghamton. We have, demonstrated through the incredible investment that New York State made with support from HUD in multiple sites around New York that now can actually demonstrate what we mean by risk reduction. So it's a pleasure to be here with you, Paul and Klaus and Tally. And we know how hard that was. It took years for us to figure out how to build buildings to code, how to make sure that communities were involved, that we had, very difficult conversations with seniors, for example, who, were not happy that they were going to be disrupted for years because of the improvements we were making for long-term support. It also was true that, Superstorm Sandy was a really critical moment, a really acute stressor, but, a lot of our communities are dealing with chronic stresses all the time. And so that's not as sexy. You don't often get the news showing up when there's a small incident, but it, over time, can really damage your health and impact your buildings. So I'm here in DC. I wish I could be with everyone. I'm stuck here, moving between the Hill and my community development finance institution and other areas of the city. It's a difficult time here in DC for a variety of reasons. I spent the last 2 years in the White House advising the president on climate resilience and then advising the president on housing policy, my two favorite things in the world. One of the first things I did when I came into the White House is I raised my hand and I said, who's dealing with property casualty risk insurance? There's a massive inflection point happening around the nation with the disappearance of smaller insurance carriers that just can't stay afloat at a time when the climate risk is growing wider and more severe. When you file a claim to a carrier, they actually have to have the money on hand to pay out that claim. And when they lose their liquidity, they can no longer pay the bills and they go out of business. Or when they cannot set their rates at a level that would help them recoup the losses, they will, like they did in California, say insurance commissioner, we are no longer able to do business in this state, in the market, because you're restricting our ability to pay or charge the true cost of the insurance. This is happening all over the country. Louisiana, Florida, Nevada, California, there are carriers that are going out of business because they cannot manage the restrictive and regulatory frameworks in which they operate. Additionally, they are unable to continue to insure highly at-risk zones. And there's been very little done to make sure that we're building to a place where we will not expose our buildings and our assets to risk. That never comes into question or play, actually, when building developments. And I've built many in California. No one ever asks you at the front end of the development, well, how much is your insurance going to cost when you build this? I ask, Paul asks, but most folks just want to get it done. And unfortunately, when you're building in wildfire zones, in flood zones, in zones that are exposed to extreme drought and heat, those questions need to be asked. So I want to take us up to the level of, sort of macro level here. What happens in a state with the regulation of insurance? So it's very important for us to know how this works. Regulation of insurance, every insurance marketplace in the United States is regulated by a state insurance commissioner. There are 50 insurance regulatory regimes around this country, meaning it is not a federally regulated space. It's kind of a Wild West environment. You have insurance commissioners like Ricardo Lara in California that are put into place by the governor. You also have insurance commissioners that are elected. You also have insurance commissioners that maybe fell into it because their father was an insurance commissioner and the grandfather was an insurance commissioner. And they are not given consistent training. So the trade association, the National Association of Insurance Commissioners, is very committed to figuring out how to reduce our risk. But when we try to think about the equation of reducing our risk and getting a commensurate insurance policy reduction, it's going to be a very state-level discussion. Why is this so difficult? Well, it's difficult for every reason in the book. You have states that have very different types of regulatory environments. In the 1960s, there was an era of great inspection and due diligence around civil rights, and at that time, it was determined that many communities were not able to access insurance. So states started creating what's called a FAIR plan, which is a plan that the state runs as a pool that the state offers to individuals and homeowners that cannot access the conventional insurance marketplace. These were created as the insurer of last resort. There are 38 around the country. Guess what they have become in the areas that have lost their carrier coverage? They've become the insurer of first resort. And the state backs this up. We saw last week in California alone, the fires alone in Los Angeles, and I'm proud to be on the commission for LA Resilient Recovery for this purpose of figuring out how to build with risk reduction in mind. The state FAIR plan, which has been the insurance of first resort for many communities dealing with fire insurance, they didn't have enough liquidity to pay out their claims. So what did they do? They asked all of the insurance carriers that do business in the state to contribute another $1 billion to their pool so that they could pay out claims. And this is just $1 billion of claims for an event that may have cost up to $30 billion. So we're seeing that this is a canary in the coal mine. And when I was in the White House and we talked about the issues around insurance, one of the questions we said was, well, what does it look like to have a national multi-hazard pool? What does it mean to pool our risk yet again after we've done the NFIP? And frankly, no one wants to do that because it's way too much liability for our nation and for our taxpayers, to be quite honest with you all. And I don't have to get permission to say that anymore because I'm not at the White House. I want to tell you this. The only way through this is to reduce our risk, is to build to code, is to fortify our housing portfolios, our roofs, make sure we are fire-wise in our community planning, unplug the sewers, make sure we have rain spouts that are not going to dump rain right into Miss McGillicuddy's basement next door. We need to double down on our climate adaptation and risk reduction, because here's the thing I want to convey, and then I'm going to turn back to Klaus. Insurance can no longer be the sole risk mitigant in our lives. We can't just go and pay for more insurance and think we're risk-free. We're not. We have to be the ones to take on the first loss. We have to be the ones that are responsible for reducing the risk to our communities and through housing. And everyone in this room that's a planner, that's a designer, that's a regulator, needs to commit to this, because there will be a point in which insurance will just be way too expensive to purchase, or it won't even be available. So that's what I'd like to convey. If we had gotten a second term, I will promise you we would have had a bigger play on insurance regulation. And this is something that many of us are deeply concerned about around the country. Over to you, Klaus.
Thank you very much for that perspective, Lori. Not only did FAIR, the California insurance of last and now first resort, end up in the red. The FEMA National Flood Insurance Program has been in the red for a decade or so, more than $20 billion. So it's clear that even with the rising rates and premiums, it will take a long time to get them out of the red negative budget that they have. And yet they get feedback not to raise the rates as fast as they currently do. What, 18%, I think, is the limit every year. But after 4 or 5 years, that ends up to 100% increase, doubling. And that's exactly what has happened already. And people are starting to complain bitterly. Now, this is the American Institute of Architects, and it has both architects and planners in it. What can these professions, architects and planners, do in interacting, A, with developers and future homeowners that self-finance themselves, or with larger developments that are, some of them are commercial, do to reduce actually that risk that Tali said we have to do? Because if we don't lower the risk profile of those assets, current and to be built, insurance will be virtually unaffordable, at least for a large sector of the population. So what can those professions, architects and planners, do to talk to developers, to code organizations? After all, there are professional organizations that make up the codes. The codes are not really done by the government. The National Institute of Building Sciences, NIPS, facilitates for private code organizations to make up a code. So what can they do, both as individuals but also as part of professional organizations, to reduce our overall risk profile?
That's a question for me?
Yeah.
Sure. I'll start, but I also want to make space for Lori and for Tali. And I will say part of my answer is really just building off of all the wonderful points that Lori was making. The goal here is for you to make sure to reduce the risk in the design and the placement of a building, right? And so that's having informed conversations with the developer or the person looking to build the asset that will be occupied by a homeowner, by a renter, for a commercial purpose or otherwise. And so really making sure at the front of the conversation to be really someone, and you know, obviously this is our licensure, right? So really appreciating what your role is, appreciating the fact that You're here to make sure that the best possible building exists on this site, right? So understanding the context, where are you building? What is the flood risk? What is the fire risk? What are other existential risks that are bespoke to that area, right? Conveying that information, making sure that people know that that risk exists, making sure, as Lori said, that they know that you can maybe attenuate that risk through certain features, elevating a building, being smart about the drainage on your property, making sure that there's the appropriate fire buffer to the next house, making sure that you're using materials that are fire retardant depending on the reason or the region and the context that you find yourselves, and other mitigative factors that inform or could attenuate localized risk, right? Conveying that information, making sure people know that as they're constructing a property over the course of a period of time, they can reduce the cost, the carrying costs associated with that property if they make sure to think into the future about the physical asset that they're going to have, and what insurance service providers are looking at as metrics that may inform whether or not that they should pay a higher or a lower insurance rate. Because as Tally can go into in tremendous detail, insurance service providers, particularly in the current day, are using fairly advanced methodologies to try to appraise for risk. And making sure that you know what that methodology is will help inform not only reducing the overall risk on the property, which protects, life and property, but also makes the property financially viable moving into the future. And so probably the shortest way of saying that is really making sure that at the beginning of the project, you start with making sure that you identify the risk so that it fully informs the design. So that would be largely from an architect's point of view. As it relates to planners, right? For planners, it's making sure to educate your communities, educate your local officials, make sure they understand when they're updating their comprehensive plans, what the risk would be in upzoning or development in certain areas of the community, making sure that the costs outweigh the benefits outweigh the costs. And what I mean by that is, if you're going to upzone in a certain part of the geography, make sure that, as Tally and Lori have said, that you accommodate for adaptation, right? Is there the appropriate road raising, raised shoreline, other treatments that otherwise allow for that property to exist in the next 50 to 100 years, and making sure that you're aligning that improvement on the coastline or wherever it may be with the parameters that will help the insurance industry appreciate that risk, so that you can make sure that you have the co-benefits of reducing the risk on the property, and also making sure that people can realize the financial benefit of the appreciation that that property is in of a lower risk by virtue of the definition.
Before you go, Tally, to follow up, a sarcastic footnote. I wish our city council would sit here and listen to Paul, because we have a lot of upzoning going on in this very town that does not meet the criteria that he just spoke about. They're putting tremendous amounts of new assets in coastal flood zone in particular. I mean, by the thousands. Tally.
Paul said all of that quite well, so I don't want to repeat anything he said, but maybe to offer an example of how we've seen some of this work. The Institute for Building and Home Safety, IBHS, is an organization that is actually supported in part by the insurance industry. They have a warehouse in North Carolina where they design new risk reduction strategies like fortified roofs, and they put those on prototype buildings, and they blow hurricane force winds at those roofs, and they see how well they perform. And they test and they test and they test. And those designs and standards, because it's also done in partnership with the insurance industry, are things that insurers can point to and trust and say those are types of interventions that can actually lower insurance costs. And I think those types of collaborations help architects and planners and engineers understand the types of things that insurers are looking for, and help insurers actually understand how the different adaptation strategies are helping to lower risk and lower avoided losses, because that's one of the things that they really care about. And so building more opportunities for those types of collaborations can be really important. And it can also work as an incentive for governments to begin adopting grant programs. We've seen a lot of grant programs that have adopted IBHS's Fortified Roof program, and they are becoming wildly successful. And one of the kind of carrot and stick pieces that they use is saying, hey, if you participate in this grant program to fortify your roof so that it won't be blown over during a hurricane, you're also going to lower your insurance costs. And that helps us both address the physical risk, which we all need to be looking at, while also addressing some of that financial risk that households are facing and bearing the brunt of.
Lori, what would you like to add to all this conversation here?
Well, I want to agree with everyone's points, and Paul really gave us a great, quick one-on-one on what to do and how to plan in the right way. And Klaus, I think you're going to appreciate this, given your extraordinary leadership in the city. We need to think about what we're going to be dealing with for the future of that building. So insurance is an annually recertified security. It is, every insurance policy is a one-year lifetime, and there's no guarantee you're going to get a continuity of that insurance policy. So every single year, you've got to recertify. And you better be sure that the insurance company, whether it's State Farm or Chubb or any one of USAA, they are following all of the trends because they have catastrophe models that they use to actuarially risk rate these properties. So when you're building a building, you have to consider your mortgaging, your financing. I mean, there's a time limit on that capital, and usually it's 30 years. So you want to think long term. What does the world look like 30 years from now for this building? What does the world look like 45 years? I think a lot of our architects of the earlier days built a little bit more respectfully towards local climate conditions. If you go to Puerto Rico, you go to Florida, a lot of the vernacular building design was speaking to the climate, right? The tall windows, the balconies, the light colors. We stopped doing that after World War II. So we build these buildings with the sense that they're always going to be the same. You'll just be able to put some mechanicals on and you'll be in a livable space. Well, we need to account for climate in this whole mix. You can't get enough air conditioners to cool down a building that is heating up because of the extreme climate temperature. Why? Because our energy grid doesn't permit that. So what I'm saying is we need to think long-term on the building design, and in your initial building development and building site designs, you need the insurance community at the table immediately upon entering the conversation. You need to have some kind of risk subject matter expert at the table. And one of the things I used to do before I came to the White House, I was at Enterprise Community Partners for many years, and I built their climate practice. And we have a whole set of tools: climate safe housing, keep safe housing. Many of these tools Paul and I used for the build out of some of these facilities around the state. And so, we know what can be done to these buildings when there's a flood risk. We need to be thinking long-term and thinking about when you're building that building, if you're at a certain flood level, like imagine what the flooding might be in 10 years when we're rising our temperatures a certain amount and the waters rise a certain level. Think about the condition of that basement. Think about whether it's a good idea to put the heat pump under the ground, right? As we did in the Lower East Side for so many years. A lot of this stuff is common sense. I love my architect colleagues. I'm a planner by trade. I think builders are critical to have at the table and contractors when we're building, because a lot of this stuff is just common sense stuff. Don't put a sofa and an art room in a basement next to a river. that's probably not a great place to put a couch, right? I've seen unbelievable mistakes in New York City for years as I've been working in New York City. Just the Lower East Side alone, I mean, I will guarantee you in 10 years, most of those basements will be flooded, not because of the Sandy surges, but because the groundwater is rising.
Yeah.
Right? So like common sense stuff. And I would also just say, you know, I've been working in New York a long time. Our issue is flooding, and not one building should ever be put up in the flood zone without concurrence with Appendix G, and not one building should be put up in New York, if you're not in the Bronx, with anything under the base flood elevation. It's just common sense. And you know who should enforce this? The city of New York, because guess who pays for the expense of bailing people out when there's no insurance there or there's no contractor? So I would just say that, you know, this is a critical inflection point for the city of New York, which has taken incredible leadership on this for years and years and years. We want to see this leadership continue. You know, we want to see this technical assistance continue. We want to see real practical guidance continue, with great programs around the city. But, you know, we have to double down, because we're not going to see that coming in from the federal level at this moment, right? It's states and cities.
Thank you. Well, we can now go into all sorts of different directions. Let me ask a few questions that have to do with specifics about the whole insurance sector. Even our insurance expert had to bail out, as we heard earlier. What is the role of the reinsurance industry? Because if I understand it right, they dictate to the primary insurers on an annual basis what they have to pay to the reinsurers. And they are on top of risk assessment more than anybody else. Whether it's Munich Re, whether it's Swiss Re, or whoever else, reinsurers, they know what's going on and they know what to have to charge. And if they miscalculated in the past year, they hit you the next year. So does anybody want to comment on that, including Lori? But I wanted to start with you, Tally.
Well, I am desperately sad that Serena is not here right now, because she would be the best person to tackle this. I mean, your points, I think, are the right ones, right? They are the ones who have the best information and data on the risk. The basic principle of reinsurance and insurance generally is that you are transferring the risk, right? You're transferring it from a household to an insurer, and reinsurance is basically the insurer for the insurance company. And so it gets a little messy, but they are the ones who often have the catastrophe modeling that is much more sophisticated. They can better understand the risk. And yes, I think we all make mistakes in terms of understanding what the risk is, but if they do, it does have larger spillover impacts. I'm going to stop there, though, because I am not the reinsurance expert, and I think that is the extent of where I feel comfortable responding.
Well, I mean, we're clearly missing Serena, but have you to add anything, Lori, on that?
Yeah, I think we'll be okay between you, Tally, and me. I think we've got a pretty good amount covered of reinsurance. I would say this. The reinsurance industry is the backstop for the insurance sector. Here's what happens. The insurance sector has only a certain amount of liquidity. You pay your premium every month, and that goes into a pool which is used by the carrier, the insurer, State Farm, let's say, for example, and they invest that money. They invest it in all kinds of things: housing, institutional investing opportunities, bridges, bonds, and they make money from your premiums, and that's in a pool, and they have a certain amount of liquidity on hand every year. But a lot of the money that they get from us is in a pool that's invested. Reinsurers come in because they provide the liquidity to pay out the claims at a certain point in which a threshold is met. So, for example, in California, the Earthquake Authority, the California Earthquake Authority, has a reinsurance coverage with Lloyd's London for that they pay $100 million for, which would cover the worst possible earthquake in California. And so it's a mandated reinsurance policy that the state requires so that there is liquidity in the marketplace. If we go back to the FAIR plans, FEMA actually within the FIP program does have some reinsurance pilots that they've had underway for many years. The FAIR plans, such as Florida's FAIR plan or California's FAIR plan, North Carolina, their reinsurer are the state treasury departments, right? So that means that they are even more exposed. I think the reinsurers are doing a lot more innovative work on risk reduction because they're the ones on the hook should there be a worst case scenario event. And a lot of these reinsurers are domiciled outside of this country. They're domiciled in the Bahamas, they're domiciled in Switzerland, they're domiciled in Europe, because the European insurance market has been incredibly sophisticated for millennia, and there's a recognition that these reinsurers are critical to make sure that the marketplace can function. If these reinsurers were to drop off, we'd have a lot of problems with making sure that these carriers can get regulated business in this country. So to Klaus's point, there are a lot of really interesting reinsurance pilots out there, Munich Re, Swiss Re, Wilson Towers Watson, that they're trying to figure out how do they reduce the front-end risk of their clients, of the consumers, because at some point they won't have enough liquidity to cover the losses. Imagine that.
Let's throw in one other technical term in terms of insurance: parametric insurance.
Funnest.
Sally.
Yes, that is a fun one. So before I explain parametric, why don't we talk about what traditional insurance is, because that usually helps to kind of illuminate some of the confusion. So traditional insurance, homeowners insurance, renters insurance, flood insurance is referred to as indemnity insurance. When you take out one of those policies, you have a contract with an insurance provider for coverage for certain conditions, whether it's a flood or wind or something has just happened to your home or your car. And when that unlikely event happens, you submit a claim to your insurer and you say, I have had damages. And then the insurer reviews that claim and then they adjust that claim. They actually often go out and actually look at the damages and then they calculate the cost of those damages. And you receive a payout for your claim based on the actual cost of the damages. So that can take a while after a disaster happens. There can be back and forth between you and your insurer about what the actual cost should be. And oftentimes, because it's actual damages, there are actual restrictions on how you can use that claim. You can't use that claim to cover, say, other economic losses that you may incur after a disaster, like having to eat out every night because your kitchen is broken, or not getting a paycheck because your place of work is closed. And so it limits how you can actually use the insurance money that you have, and often takes longer to reach you. So that's traditional insurance, and there's this claims process. Parametric insurance is, I often refer to it as pre-contracted. It is designed around a measurable trigger or hazard. That could be the size of an earthquake, the size of a hurricane, wind speed, amount of rainfall per hour. And in your contract with your insurer, it says if it reaches that threshold, you will receive a payout of a specified amount of damages. And that whole agreement, it can take a while to produce because there's a lot of data and research that has to be done to figure out what makes sense in terms of a payout, what would be the estimated damages if an event of a certain that size happens. But because it's pre-contracted, it also means that it gets you a little bit faster. You don't have that adjustment period and that claims process and that back and forth, so it can actually reach people more quickly. And the money can be used more flexibly. It doesn't have to be used specifically on the actual physical damages that you incurred, because it's not, the payout you're receiving is not based on actual damages. It is basically an estimate. The challenge with parametric insurance in the United States right now, as Lori mentioned, is insurance is regulated at the state level. Well, what I just described to you as parametric insurance sounds a whole hell of a lot like gambling to a lot of people. And so what we've started to see, and Puerto Rico has really led the way, is insurance regulators actually writing into the regulation parametric insurance as part of the insurance law, so that you get rid of some of that confusion and uncertainty around whether this is actually insurance. Puerto Rico has done that, and they now have a growing parametric micro insurance market that really came out of Hurricane Maria. California has that for their earthquake authority. We're starting to see more pilots that are exploring parametric solutions pop up. New York City has a pilot that's actually using it almost like disaster assistance, where a nonprofit is taking out a parametric policy, and if it's triggered, we'll use the money for emergency cash grants. There are interesting case studies where parametric insurance has also been used to support coral reef restoration in Hawaii. If the trigger happens, then the money can go to restore the coral reefs. And so there are these really interesting examples that are emerging that help to fill some of the uninsurance and underinsurance gaps that exist as a result of parametric insurance, while also potentially helping to support some of the risk reduction, adaptation, interventions that can happen post-disaster after a policy is triggered. There's some really, really cool examples, and we could probably spend a single night on any one of those examples and dig into them, but that's just sort of the high-level snapshot.
Paul, you want to add?
I think Tally's been as comprehensive as anybody possibly could be. She'd worked and she was instrumental on building out the parametric pilot in New York City. What I'll add, and I'm trying to think about this in the context of, as a planner or an architect, why is this important? And I think at this point in time, there is insurance innovation. We do need to pay attention. And as you're thinking about designing a building, think about whether or not parametric policy is available to provide cash resources to address a climate risk that that building may face. I'd also like to flag that in the last legislative session, New York State just legalized parametric insurance for the first time in its history, and the Department of Financial Services is in the process of designing regulations around parametric insurance. So to the extent that you are interested, but really probably over the course of a period of time, you should pay attention to how these conversations evolve, because it's not it is not only about protecting homes. There are other parametric measures, again, as Tally said. So say you're designing a park space, a parametric measure is if the wind blows too fast, right? Well, that has implications for trees where branches may fall, right? Well, you could get a parametric policy that could allow you to make the repairs to the trees, or to do the due diligence and maintenance on the trees to make sure that you still have a safe park-like environment. So it's a really dynamic set of issues to start to explore. Again, Tally went into great detail on that, but just thinking through practically what that means for you in this space, and just a flag to start following that conversation over the course of a period of time. Lori?
Before Lori adds something, I just want to point out that the parameters that trigger that are typically provided by federal agencies. For instance, for an earthquake, it would be the magnitude as determined by the U.S. Geological Survey within a given prescribed area that this event occurred with a given magnitude. For wind speed, it would be NOAA, the National Weather Service, that would provide the parameters and say, there was a tornado that had such and such wind speed in that area, okay? So, and yet we see, of course, a tendency that many of those federal government agencies are being reduced in their capacity right now. So it will be very interesting to see whether they will be actually able to provide the parameters that parametric insurance assumes they will provide. Lori.
Folks, that was a great foreshadowing for our space right now. Like, will the federal government be able to provide us with the level of capacity we need? I mean, you know, the reality right now is we have at this very moment a lot of really smart people losing their job across the federal government that have been thinking about this stuff for a long time, whether it's at the Treasury, whether it's at HUD. FEMA, as everyone's probably been following, has been, you know, extremely impacted by recent cuts. So, you know, the good news is the federal government never provided oversight over the P&C insurance market. It's always been the states for over 100 years. So that's the good news. There wasn't any capacity we were depending on to begin with. So for at least this space, you know, I do think that this is a consumer protection issue, but that was not taken up yet. And the NFIP program is something that we need to all follow very closely, especially in New York. That's the one area that I'm very concerned about right now in terms of any impacts to FIMA. And I love what Tali and Paul said about parametric. We need an insurance innovation in this space. I'm so proud to be part of a group that Tali's organization sponsors called Insurance for Good, thinking about how do we innovate at the local, the community, the regional, and state level. I think what we need to do is get our insurance commissioners schooled on some of these issues and in partnership with them, really try to find some way to innovate ourselves through this. At the end of the day, I think where we should focus some of our time, and I know I'm in a room of architects and planners, I'm a planner, but I'm also very interested in capital for this work and bringing capital to this space and finding a way to get more investment into this work. So when I mentioned that a lot of the insurance industry, the institutional investors from these insurance carriers have a lot of funding. They're investing in housing and all kinds of amenities and infrastructure improvements. What would it look like to talk to some of those institutional investors about investing in a risk reduction play for communities that those carriers are doing business in? Imagine State Farm investing in Firewise communities in a state that they're having a really hard time staying in place because of the risk that's so high. Imagine doing that in New York City. Imagine having the New York City Insurance Commissioner step forward and say, you know, if you want to do business in New York State, you're going to have to invest in a $10,000 grant to homeowners like they do in Florida to help them reduce their risk. That's really happening. The Florida Insurance Commissioner is really doing that. The Alabama Insurance Commissioner is saying, if you want to build housing in Alabama, you've got to do a fortified roof. So a lot of the governance and the influence is going to come from the insurance commissioners. And again, the marketplace is critical in having private investment at the table. Having investors that build multifamily housing understand the risk they do and invest in those additional measures. So innovation is key, and I think, Klaus, what you brought up around the parametric is about innovation. It's about thinking out of the box. And again, another area that we're looking at consumers innovating is, you know, the deductible bargain. Like, I'll pay more of a deductible and I'll pay less premium. And a lot of homeowners and building owners are making that choice. It is a bit of a Russian roulette, though, because if you say that you're going to pay the first loss and risk in your deductible, you better have that deductible on hand. And so there's some innovation I can imagine coming forward with helping subsidize that deductible for lower income households. It is time that New York State gets serious about this risk and steps forward and does some real thinking about how to mitigate this massive material risk. I don't know if anyone in the room has seen The Big Short, but I always love that movie because to me, the next big event is our insurance industry is unable to meet the needs of consumers, and you start seeing stranded assets, you start seeing properties that can't appraise, you start seeing essentially a modern day redlining where you have communities that are underinsured, they're not insured, and they lose out. And a lot of these communities are going to be low income, working class communities.
Thanks. Now, we have talked a lot about housing and communities, but there are other assets around that are being affected by disasters, namely infrastructure. And our infrastructure is often partly privately owned. Con Edison provides a lot of services, whether it's gas or electric, in some places even heat, steam. The communication sector is largely private. The transportation sector is more public. Now, what do we do about those things? Are they insured? Are they self-insured or combinations of self-insurance and outside insurance? And is there another disaster in the waiting that maybe some utilities go belly up because they are not insured? Does anybody has any expertise in that arena or not?
I think it's an interesting question. I can say that the answer to your question is yes, right? So there's private assets, there's public-private partnerships, there's utilities, there's public assets. Each are insured in their own way. You know, like a village on Long Island, I had an oil spill on a living shoreline that I worked on. The village of Rockville Center is self-insured in New York State and ultimately had to pay for the reparations of the living shoreline up to the standard that it was built, right? And so that's one example you'll see. You'll see Con Edison, that's a regulated regime in New York State, but a private party, so they have to have appropriate insurance. You know, you raise a question of whether or not they are insured in a way that will address all means and methods of climate risk. That's an open conversation. I defer to others on that, but my understanding after Sandy is the answer is no, and that's why FEMA had to provide a lot of public assistance to our utilities, to our local governments, and to other public-private partnerships that were responsible for the facilities that we use and rely on every single day or to protect ourselves. And so there is a real risk here to, you know, our common infrastructure that we need to really appreciate as we're having our insurance conversations, but just setting the stage as to like, what are the different permutations that we're seeing? All of the permutations that you described are in fact what we're dealing with, which present a range of issues in part because they are all insured differently by virtue of the kind of entity that they are, right? The self-insurance that we talked about on Long Island versus private homeowners insurance, right? And you have the issue that's related to climate risk, right? Which are a variety of different insurance typologies that Tally discussed and probably could elaborate on further.
I think I would go back to what I said at the very beginning, which is that everything is underpinned by insurance. All financial activity is underpinned by insurance. And if you don't have insurance, in order to make those repairs, that money has to come from somewhere. And so to Paul's point, utilities that don't have insurance or entities that are self-insuring and don't have enough money to cover their damages, eventually they still need money to do the repairs after something happens. And so if the insurance market is breaking, that isn't just an issue for housing and homeowners insurance, that's an issue across the board. So many things that we don't think about require insurance and use insurance in different ways. This is actually an issue in the clean tech sector a lot of the time. Innovative products have a really hard time getting insurance. Well, clean tech products are doing really amazing things to help mitigate emissions and lower decarbonization. But if they can't get insurance, then they can't actually scale and deploy. And so this is true across the board. I think, again, to Paul's point, the different ways that entities are insuring and self-insuring can have implications for the overall financial health moving forward. And that also makes, those innovative solutions that we were talking about before even more important. The more innovative and diverse insurance solutions and financial solutions you have will help to cover some of these gaps where we see uninsurance and underinsurance, whether it's in the housing sector or otherwise.
Okay, thank you very much. I think, can we have a brief closing statement from all three panelists? Because we even haven't allowed the audience to ask any questions. Maybe I will not allow you to make closing statements. Does the audience have?
Are we holding a White House correspondence event?
So,
No more
can you
questions?
come up, or you have a microphone? Good.
Hi, thank you for having this presentation. I have to say for myself, the idea of having the intersection between insurance and design is something I actually think about a lot. So thank you for, it's quite an innovative session. I actually work in real estate development, so this is something that's been something I've been thinking about for a long time. If I could say to you what I wish we had to help us, it would be that for here in New York City, I feel that the solutions we have are very narrow-minded, and I'd like to see I would like to see us in solidarity, perhaps, with the insurance industry to allow more creative, out-of-the-box solutions. So if I may, I'll just give you an example from a couple of the jurisdictions in the city. So first of all, the building department, right? We have laws to help us with energy, right? Local law 97, 92, 94. But I can't get a credit if I want to do something that doesn't require buying solar panels. What if I want to put shades on the outside of the building? I don't get a credit for that, and I'm working against a design culture that doesn't want that. And also in the city, we have a lot of landmarks projects. So depending on where your portfolio is, that could be a significant fraction of your projects. I think another thing is in the department. I'm sorry, I will. Another thing is with flooding. You're talking about basements. One of the things that I now look at from experience is what is the size of the pipe in the street? Because I've learned the hard way that these old 12-inch pipes that now, if they were there, they're supposed to be 36 or 48 inches. And so I'm going to have flooding no matter what. And so what I've started to do is I don't do any gravity plumbing in the basement and maybe not the first floor, and I allow the pressure head to protect the building, because a check valve only works for 5 years and they can break under a certain amount of pressure anyway. One more thing, just Department of Transportation. Again, it would be great if we could lobby to find places that have a certain amount of minimum traffic, like under a certain level, and we could allow like a gravel road instead of an asphalt. But I would welcome innovation in what we're doing. Thank you.
That was not a question, but a very good statement.
Thank you.
Hi, I have two questions, so I'll try to be really quick. The first one is I appreciate all the things that Paul said, but a lot of the clients I've experienced are knowledgeable about the climate risks, but they are developers who are either looking at turnkey or they're selling within 5 years. So they're just looking at how much is the mitigation cost versus their pro forma. A lot of the times the cost benefit is not there, and basically they just transfer the risk to the next buyer and call it a day. Also with certain insurance companies, right? They're not all the same. They're not all sophisticated. And some will say, oh, you did X, Y, and Z, cool, doesn't matter what, you did something, here's a 5% discount. Others are saying, oh, you're in this zip code, I don't know how to evaluate A versus B from designer this designer or that designer. You're in this zip code. This is your rate. Call it a day. Like, how do you mitigate against that when it's basically how do you navigate that? And then my second question is around, with the current administration, a lot of federal resources on climate data is disappearing. And so what are designers to do when they want to look for sources?
They can go to the NPCC, the New York City Panel on Climate Change.
I'll tackle the first part of your question a little bit, because this is something that we're thinking a lot about. And actually the organization that Lori mentioned, Insurance for Good, which is in partnership with EDF, is thinking a lot about. And I think actually to the comments from the initial person, this idea of what are the adaptation strategies that actually influence insurance. Right now, it is fairly narrow-minded. There are not a ton of interventions, whether you're looking at NFIP or you're looking at private homeowners insurance, that actually seem to have an impact. And so part of it is actually working with you all in this room and planners and engineers and developers to understand what are the benefits of these designs that you're doing, to be able to show what those avoided losses are, play a really important role for insurers. And I think, as Lori said earlier, bringing insurers to the table from the beginning can help to create some illumination between the parties so that insurers actually understand what are you designing. And then having insurers at the table can help developers, they can help designers understand what are the ways that insurers are actually thinking about risk. And I think that also opens the door for a lot of innovation and opportunity. I mentioned IBHS before, and I think that's like a good example of how some of this has worked. We need more IBHSs out there that are bringing together the partners and also looking at community level work. What are the needs of the community, and how can insurers and architects and designers be working together to understand those actual adaptation interventions, and getting actual data to insurers. Insurers live and run on data. Communities have a lot of really good data that isn't necessarily getting into the hands of insurers. That makes it really hard for them to say, this amazing new design that you've done is actually having an impact on X hazard. And so creating those opportunities for cross collaboration and data transparency, I think, is going to be really important. Your second question is one that is just honestly really, really tough, but I do think it makes local data even more and more and more important, and we're seeing a lot more local data resources that, if in partnership with an insurer, a community can still help provide some of that information on the hazard for developers as well as the insurers.
I want to make some space for Lori, but just trying to quickly answer your question. Your first question, having a little bit of a sense of humor, is how do I get a developer to spend money, is difficult in all circumstances, right? And so I think part of the answer to your question is, this is an inflection point, as Lori said, right now, where people are seeing real risk in a new way that is impacting their bottom line over the course of a period of time. So being clear and transparent and articulating that making this improvement will actually sustain the value of your asset over the course of a period of time, and making sure to understand that from insurance service providers and from the data that might be available to help make compelling arguments, I think I'm hopeful can help turn the page on that in part. The second part of the response is that, and this is something that I would defer to others who are more sophisticated on the matter, right, is that there are instances where you have your pro forma and you have your O&M for a building, but you have an entire portfolio, and in some part your insurance is a function of your fuller portfolio. So if you make resilience improvements to a particular building, it could actually positively impact how much you're actually covering for all of your buildings over the course of a period of time. So just making sure to try to pay attention to the conversations with insurance service providers, learning, figuring out strategies to do the case making that's necessary to really help them appreciate how to preserve their asset. And then before I send it over to Lori, I can't advocate enough for folks to pay attention to the findings of the New York City Panel on Climate Change. You have academics who are leaders in their field, thinking day in and day out for 3-year cycles on what the future 2080, 2100 will look like in New York City. Is some of the most robust data that you'll see in the entire country on climate change, and we luckily locally have that available to us. And wherever you see there impediments to being able to leverage or utilize that data, I would reach out to the department or folks within New York City government to try to make sure that insurance service providers know that it's reliable state source data that can really help inform outcomes. And then I think we're all grappling with, aside from the Wayback Machine, how to collect data that was available a month ago, really some innovations, data and white papers, a lot of which Lori led the charge on. And so I try to keep those in my records, and I'll turn it over to you, Lori.
Okay, Lori, a 2-minute closure, and then everybody
I'll do
2-minute
New York.
closure, and then we go back to drink and private conversation.
I don't want to hold you up from drinking, so I'm going to say this. Because I'm going to have a cocktail as well, virtually.
Good.
It's been a long day. So, 2 things I want to say. One is, when you have your insurance person at the table, and like Marsh McClellan, they have great advisors, they will say to you, here's what your insurance is going to cost per unit for this building. It's going to be $300, $800, $1,000 a unit. And then the developer can say, well, I will make a determination as to whether or not this will be a return on my investment that's worthwhile. Because at some point they have to resell that facility. I've done this all over the country. I've brought insurance brokers in. We've estimated the per unit cost, and it's changed minds and hearts around this. So I want to just double down on that. Here's the thing about the federal tools. When I was at the White House, we had lots of conversations right before the close of the administration to preserve and protect our federal tools. Our federal tools that we've built are safe. They are now located and co-located in many different spots. The Wayback Machine is definitely there, data.gov, but NOAA is still there. I would say that I post every single day, almost regularly, on all these tools where they can live. We have these tools. We're going to continue to support them. New York City is going to drive innovation. California is going to drive innovation. All of the states and cities. And then when we come back in 3 years,
Think of closing.
we'll have an opportunity to have these tools in front of us. So that's what I would encourage you all to do.
Thank you very much, Lori. Kelly?
I didn't realize we were all
1
in
minute.
closing. You're putting me on the spot here, Klaus. I think I'll
They're coming down on us.
yeah, I think I'll just go back to a concept a lot of us who work in climate change, or sort of the constant refrain, is that we all have a role to play. Insurers have a role to play, policymakers have a role to play, designers, engineers, architects, all have a role to play as we're thinking about climate change, adaptation, and mitigation. And it's going to take all of us to work together to actually make transformational change and build resilient and insurable communities moving forward. Insurance is a tool. It's an amazing tool. I talk about it all the time, but it is not the only tool. And absent of reforms and action on the part of all of the other sectors, it in and of itself isn't going to fix all of the issues. We really have to get to that root cause of what is driving the problem, which is climate change.
I'll be probably the quickest. I will say that I feel in part hopeful. I'm surrounded by planners every day. I'm honored to be here as president of the American Planning Association with planners leading the charge, trying to figure out how to achieve the future that we want to see in partner with architects. And we together, with our 2 professions, have done things unimaginable to the generation before. And that's partially why we find ourselves in a building right now that we all came to, likely off of a subway, subterranean, just thinking that this whole situation is just mundane when you think about a generation, 2 generations ago, the early 1900s. This wasn't even possible. So I'm very confident that we are going to figure out how to deal with the implications of climate change and set the stage for future generations to live well in New York City.
Well said.